Well, hi traders, it's the trade-off today. We look at Nvidia's numbers, very, very strong indeed. We look at the Fed minutes and what that means for the reaction in swaps pricing in the US dollar. We look at crypto, which is seeing a bit of a bloodbath at the moment. And we look at the trades that really matter on the market at the moment. There's a lot going on. This is the trade-off. Hi, my name is Chris Weston, Head of Research here at Pepperstone, and we're joined in 2 seconds by my friend and colleague on the show, Blake Morrow from Forex Analytics. And we'll be discussing all the factors that are going on in the world, the fundamentals, the technicals, the price action, the movers and shakers, and see where we like to be positioned in this market and the directional skew going forward. Mr. Blake Morrow, coming to the programme, my good sir. Well, we're getting into the business end of the year. People might start to chase. People might start to cut back a little bit. A little bit of volatility coming into markets, which we love. How you feeling, brother?
Well, I mean, look, we just came off Nvidia earnings, and stocks up 6% post market. All is good. The world is good. Everything. Santa's coming. Did you know that, Chris? Santa's coming.
Love him. Cost me a lot of money at this time of year, so bracing that one. Need to make up, recoup something in the markets to try and fund what's going to be a very expensive Christmas, no doubt, in the Western household. Let's go into the fundamentals and look at the tactical thematics that are playing through in the market. Topical Thunder. Nvidia's earnings, they came out just a short while ago. Just before we were airing this, we hadn't heard from Jensen Huang, the CEO, who will be giving his analysts conference call. And I think there's going to be a lot of focus on the $100 billion investment in OpenAI. OpenAI is everywhere at the moment. It's got investments all over the world. It's chucking cash around, making deals in Korea, Taiwan, America, everywhere. It's just it's one to watch. But we're also focused on his view about the additional 14 million GPUs that need to be sold through calendar 25-26. There's obviously a lot of factors around data center investment and the growth that we're going to be seeing. Also things like electricity demand and power usage and the cost of electricity by that time as well, where people are saying there's going to be some sort of shortage in terms of power generation there, or deficit, should we say. But the numbers, Blake, are very, very good. You know, the bar was high. We know they always beat. They always beat on revenue. They always beat on earnings. And they have done again. I mean, their Q3 numbers were just above the streets, but they've guided for Q4 of $65 billion. I think that was about $3 billion above where the street was positioned. So that's where I think a lot of this is coming from. Gross margins, you've got to look at gross margins from Nvidia. Valuation for these high-tech names is driven by margin expansion, and that's going in the right direction. I mean, they've guided to 75% for Q4, which is just above the street. I mean, there are things that we are a little bit concerned, less causing some headwinds in the after hours. I mean, I think, their free cash flow is $22 billion, a bit light on the expectations there. And their operating expenses were probably a little bit above expectations. But, this is a company, when you listen to their GPUs, they've sold out. They're saying the demand's off the charts. I mean, you can't get much more bullish than that. Their cloud GPUs, again, sold out. You can't get much bullish than that. So it's all about Jensen Huang, but the stock's up in the after hours. Has it found its mojo again? Are we going back to $200 and 212 all-time highs?
Well, we were just trading post market. We were just trading around 198. We've come off to about 194. The stock's trading up 4%. Jensen is speaking right now. He just mentioned that there's been a lot of talk about an AI bubble, and he says we see something very different. Obviously, he's out there talking up the markets. I mean, that's what he does, and he does it really well. But something that he's saying that has turned the stock a little bit lower. I'm not really too sure. It might be some of the comments regarding China, and they say they're still struggling with some of the geopolitical risks that are surrounding China and whatnot. So, but overall, Chris, you know what I think is going to be the most important. Like we're gonna see this play out in the after hours, but as I'm going to show you a little bit later, so make sure you all stick around, because one of the charts I do want to show you is I want to show you Nvidia. I want to show you what happens after earnings, because everybody seems to believe that Nvidia is just a slam dunk, that, they beat and everything's great. He always talks, Jensen always talks a great game, and it's always blowout earnings. Expectations are high. They always surpass that. But it doesn't mean the stock will rally. I mean, it may be rallying post-market right now, but what's going to be really interesting is how the market responds over the next 24 to 48 hours from now.
I agree, and I think sentiment towards AI has been pretty badly cut up. I mean, asset managers, if you look at their 13F filings, hold 397 million shares. That's $72 billion of notional. But there's no other stock that comes anywhere close to being held like that. Microsoft second, but this is a core holding already. The question that we've got now is will this kick? Will we get the earnings upgrades, the revenue upgrades from the street, from the analysts to keep pushing this to new highs? Because sentiment has been really pretty badly shot up recently in this space, and people have been looking to take their exposures down a bit. So is this going to be a pop for people to look to sell more stock into, or will this kick? I think that's what price will tell us in the next couple of days.
I agree. And you know what we're going to get in the next couple of days, matter of fact, we're going to get it in less than 24 hours from right now, is the September jobs report on a Thursday. We got NFP from September that the market is going to react to tomorrow. Chris, I wanted to bring this up because we as traders were so starved. I know that I'm talking to a mostly Pacific Asian group when I'm speaking on this show. I hate it that so much of it is centralized to what's happening in the United States, but really traders love US data. I mean, the US economy, it's still kind of that economy that everybody is really focused on for global growth right now. And we're really focused on the jobs data that's coming out tomorrow. We haven't had data because the government was closed for the longest, US government was closed for the longest period it's ever been closed. And so we're going to get this September data. And I think the market's actually going to react to it because it's going to give us the data that we should have got just as we were going into the government shutdown. So I think it's going to be a really interesting reaction. And you've seen the dollar rally today. I know you're going to bring a chart regarding the dollar a little bit later, so make sure you all stick around for that. But how should we take the September data that we're going to get, and should we be trading it aggressively? Are you telling your clients, hey, we got to be paying attention to this?
I definitely will be telling clients to pay attention to it, mostly because now the October non-farm payrolls has been pushed out till the November one, when we're not going to get that now until after the Fed meeting. So this is the last payrolls report until the Fed meeting on the 10th of December. So, if this is the thing that everyone looks at, or the Fed look at really closely, this is the last payrolls report. And we're going to get the anecdotal evidence from the weekly ADP numbers and jobless claims and jolts and whatnot. But this is the last payrolls number until that, because the November or the October one will come out with the November one, which is going to be reported on the 19th of December, after 9 days after, calendar days after that. So this is the last bastion. So how much weight do we put on it? I think we have to put some weight on it for sure, and I think the market increases its sensitivity. That said, I think predicting where this is going to go is very, very hard. I mean, the market's looking for 50,000 net jobs, and unemployment rates stay fairly steady. But I think that job level of creation is, I think, people are saying that the break-even rate now for job creation from payrolls is about 25 to 30,000. So 50,000 would be all right. I think equities, they just want that happy medium. They want that sweet spot, but it doesn't really change too much. So something about 40 to 70,000 would be a good number for payrolls. It would show that things aren't so bad, that we're creating jobs, unemployment rate unchanged, and I think equities rally. The dollar, though, I think the Fed, from what we saw from the minutes, is saying give us reasons why we should cut, rather than this idea about we've got a default setting that we probably will cut in December. We just need reasons not to cut. So I feel, market pricing now has swung to 35%. So I think, anything above 50,000 in payrolls and an unemployment rate unchanged, I think, things aren't so bad or less bad. And, the default position from the Fed will probably be a hold in December. And, that could be a positive for the US dollar.
It's going to be an interesting one. So remember, that's coming out less than 24 hours from right now.
It's a bit of the whole thing's a bit of a mess now, really, isn't it, in terms of payrolls? I mean, we're getting... In the November series, which came out on the 19th of December, the October one which comes out at the same time as the November. So we get two sets of payrolls. We're not going to get the unemployment rate as part of that October because they're only, we've got the establishment survey and the household survey, and they're only going to be reporting the non-farms, but not the unemployment. So a whole bit is a schmozzle, to be honest. But there we go.
Schmozzle. I've never heard that.
Yeah, well, you don't use it too much. It's one of those words that you sort of bring out when you really have to, just to emphasise a fact. Anyway, let's talk about emphasising a fact. Let's go into crypto, because it's absolutely been taken downtown to Chinatown. It's been cut up. It's been monkey hammered. Bitcoin's down close to 30% draw. Sorry, mate. Do you want to take some time off? I don't. Anyway, look, 30%. We're close to 30% in the drawdown from the recent highs that we've been, or the all-time highs in Bitcoin. Now that's been faring pretty well. I mean, one of your favourite coins, Blake, Fart Coin, is down 92% from its high. I think some of these really crappy meme coin, altcoins, whatever you want to call them, they're Darwin theory. They're getting taken out because they just don't deserve to be around. They're not part of the ecosystem. They're not going to be part of the adoption story. They hold no clarity on the movement at all. So yeah, they deserve to go down to zero, in my opinion. But it's the generals, the stuff that actually moves forward. So your Ethereums, your Bitcoins, your all the stuff that's on the Ethereum network, using that sort of situation that's very much involved with the stablecoin movement. They've come big drawdown and really massive liquidations taking place day after day. Technicals are shot to pieces. The market lost a lot of confidence after the 10th of October flash crash, and we just haven't really recovered at the moment. Now we might see a bit of a pop on in crypto stability because of what we're seeing in Nvidia and the sort of sympathy with risk there. But yeah, I think this is really dark. So where's the low? Are we seeing a low? Are we close to that point after the flush out, or are we just staying cautious?
I'm trying. Wait, what did you say? Monkey shot?
Monkey hammered.
Monkey. I'm going to use that. I can't wait to monkey hammer somebody.
You don't monkey hammer someone. You monkey hammer a market.
Oh, okay. Monkey hammer. All right. Got it. Yeah. Can't wait to monkey hammer the yen. Got it. All right. So, as far as are we near or low? Well, everybody should know the 75,000 level in Bitcoin is I would say it's the bull bear line. I mean, it's the line.
We're miles away from that at the moment. So you reckon that's the point you'd be chipping away at longs?
You say we're miles away from that. We're a week away from that. I mean, just a week ago, Bitcoin was trading well over 100,000. Today we traded below 90,000. I mean, if things continue to go the way they're going, you got Ethereum that's closing in on a 618 retracement, which is July highs. It's basically testing that. We're like within a whisker away from that. These are pretty important levels. And I was having a conversation with a few of our traders today about Bitcoin versus gold. And I think, if you're an asset manager and you've recently adopted crypto into your institutional funds over the course of the last year or 2 years, you're looking around going, do I hold Bitcoin or do I hold gold? And I think that's one of the reasons why precious metals is actually holding up not so bad, is because you're seeing a lot of liquidation of some of the crypto assets out there. But I don't know where the bottom is, Chris. And what I am scared about is if Bitcoin does crack that 75,000 level, let's say it's by the end of the year, or maybe it's in a couple of weeks that we get down there again. What happens to all the other coins? So I don't see. I know we're getting close to support, but support and resistance levels are made to be broken.
Yeah.
And
it's like promises. But the one I'm looking at as well is these treasury entities, the Bitcoin and Ethereum treasury entities. These vehicles that were set up like custodians to just buy Bitcoin and Ethereum onto their balance sheet. We talk about strategy under Michael Saylor. Well, that's been carved up now. But the other one is Bitcoin Immersion. Tom Lee, your mate Tom Lee, who has got into this. Their average price on Ethereum for the holdings that they've got, I think about 8% of the cryptos out there, of the Ethereum outstanding coins. I think their average entry is about 3,900. So they're sitting on a massive paper loss at the moment. So you just got to ask what's going on there. And actually, if you look at the Bitcoin ETFs, the spot ETFs, that I think there's 11 of them that came out, last year or whatever it was. The average cost basis for the average price that's been accumulated for all ETFs that have been purchased is 89,600. So that's not going to act as a floor. It's not like the options market where that's going to act as a barrier. But it means if it drops through there, that the average person holding is going to be underwater and losing money. So that means if it falls, then you probably could see some of those people looking to liquidate some of those, see net outflows from the ETFs as well.
I haven't seen Tom Lee on CNBC recently. Weird.
No, it's going to be in a world of pain at the moment, because he was talking about Bitcoin going up to what 250,000 by the end of the year.
Yeah,
I think it might be 25,000 by the end of the year. If it keeps going this way.
Oh boy. Let's move along. All right. So I want to talk about, both your and my wheelhouse here, FX. And I want to ask Chris, where's the play right now? Because I think the euro's in that level, around the 115, 116 level. And I have no conviction. And I know whenever I get in this situation, Chris, and I don't have a lot of conviction in FX, clarity will come, and it may come as early as tomorrow. It may come as early as seeing the jobs report and seeing the reaction. And nothing gives me more clarity and conviction than price. I mean, that's just the bottom line. But right now, the euro doesn't give me a lot of conviction. I'm looking at the Aussie dollar, which has failed to rally with risk assets, tested the 200 DMA. And my fear is if that thing breaks below 64 cents, I mean, we're going to see 61 cents. And I know you've been a really staunch Aussie bull, and it's worked really well against the Kiwi, but against other currencies, it's been pretty weak. And so like, I'm looking at that. I'm like, does the Aussie actually just give up the 200 DMA? This dollar yen's on a breakout, but is the BOJ going to step in? We're going to talk a little bit about that here in a minute. And you look at currencies like the euro, which are just kind of like in no man's land right now. So what's the play in your view with FX?
Well, I think right now there's some good tailwinds to the dollar. I think I like dollar yen higher. I know everyone's positioned that way at the moment, but I think you're going to get headlines on the wires talking about watching levels and all that nonsense. But and you've also seen local speculation in things like the Nikkei news publication talking, bigging up the intervention risk now. But, do they look on rate of change, or do they look at absolute levels? So it's the rate of change. So that, we could see headlines feasibly coming out very, very soon on watching levels and talking to dealers about rates and all that kind of stuff. But I think you buy the pullback. I don't think we're near that levels at the moment. And I think Trump starts to whack out tariffs on Japan if they start doing that as well. So, I still like the dollar. I think the dollar index breaking out. I think it's got, they've got this repricing of the December cut. You've got December, the terminal rate, which is moving up in that. You've got real rates in the US, which, 10-year real rates at 183 at the moment, a break of 185. I think that puts upside into the dollar. You've got the exceptionalism story, which seems to be big, could ramp up now because of Nvidia. And you've got relative growth. Although I will say this right now, that US growth, running up sort of 3.5%, very, very strong in the eyes of the market. It's all capex from the hyperscalers. There was an article, there was a white paper that came out from Harvard that said 95% of US growth, GDP, in the first half of this year was from the 5 hyperscaler capex spending. Otherwise, growth in the US would be close to zero, and that would give them scope to be cutting rates. So I think, that it's, you've got this economy which is looking really hot, quite hot. I mean, obviously, the labour market is obviously a situation that's different, but everything's down to capex. And you're seeing that you're seeing that disconnect in Target's numbers. I mean, their Target's numbers were pretty poor. Walmart's numbers were coming out in the session ahead. The low end retailers in the US are doing poorly. You're seeing that in very subdued revenue growth. Everything on the upper end is doing quite nicely, but it's all the growth's coming through from capex spend really. So it's a bit hard behind the scene. But I like the dollar. And I like it against the yen. That's the way to go.
It feels, Chris, the way you map it out, it feels like that old musical chairs, and the music's gonna stop, and there's just a couple people surrounding that one chair, and what happens when the music stops, buddy?
Right, it's like going swimming naked, isn't it? The old Buffett analogy.
They're not wearing any panties.
Or is that more to do with Ponzi schemes? You've last man out. Yeah. Anyway, let's move on. Let's go to the charts that matter. That's the setup. let's go dollar index. I've just been talking about it there. I talked about this burification that's happening in the US economy at the moment, high end versus low end. Real household incomes are getting squeezed. See, that's something we're watching. But I think the market's getting geared up for a dollar positive payrolls number. I feel like market's going into it obviously long of US dollars. They're feeling the risk is that we're going to get a good number. I know that ADP, the weekly numbers there suggest it's going to be quite weak, but I think the market's expecting or positioned for an above expectations number there. They're getting set for the Fed to be on hold in December. What could that mean? But look at the setup now. When we're talking about we're through the 200-day moving average. I think a break of that level could be quite significant, and that takes the range target, if you want to do a measured move from that, is 104 there. So whether that gets there, over 2 weeks, a month, I don't know, by the end of the year, if not Q1, that would be where the target would technically sit. Whether we get there, obviously, is another factor. But I think this is a chart that's come up on everyone's radar. Obviously, the euro in that basket is 57.8% of that weighting. So you need to take a view that euro dollar is going to be going down, and dollar yen keeps pushing up, and cable makes a bit of a move lower. But this is a chart that a lot of people should be watching if you're an FX trader, because I think we're about to see a breakout. And the question then is does it kick? Does it fail? Does it start to trend? I think that's going to be the objective there. But I think that breakout looks pretty good here.
It does, and I'll tell you, that should put the euro somewhere in the 112 range, in the 112 handle. So if
but look at the close as we're going in. It's right, price is right at the top. There's not been a test of the double top, and then rejection, sellers coming in. It's closing, or it might have closed right on its highs. I think that's a pretty positive sign there.
It is, Chris. All right. Well, hey, I want to take a look at Nvidia, and I do want to take a look at the chart here, just because, I know everybody's looking at Nvidia and saying, oh, we're up. And by the way, I'm looking at the stock right now. We're up 4.3% at the time of recording, post market. Stock's trading around, it's trading around 190, 194 and change. And, we're coming right back up to that 161% extension. I do want to say that the 180 level, that's the rising trend line. That's that spike low from earlier this week. That 180 level, that is your bull bear line. And if we get below it, that's when you have to know as a trader, where am I wrong? If you want to play on the long side, that's fine. I think that Nvidia still looks good. The earnings just came out great. If it trades closer to 180, I think that gives you a better, more optimal risk reward to be on the long side. But if it gets below 80, Chris, that's when things get a little dicey. And then I'm looking at that purple line at 164.60. Now I know it seems like eons away, but that's a level that bulls definitely don't want to see broken, because we would be making significant lower lows. But keep 180. That's in your back pocket. That should be a level that you focus on, even if you're trading equities and you're just trading, risk in general. Just watch Nvidia. If it gets below 80, that's where things might get a little dicey.
It's interesting because on my little notepad, I've got 180 as my level as well. I would actually show you just to prove, but I'd pull my wires out and smash the place up in a China shop. So I'm not, but 180 was the level I'm looking at as well. The thing is with Nvidia, it's a momentum juggernaut. There's a lot of passive flows that take place. It's 7.9% weighting on the S&P and more on the NASDAQ. So what you get is, if the market rallies in the session ahead, you get this disproportionate purchases of the ETFs from the ETF makers of that. So you get this, and then you get the chase coming through. You get so much optionality. People buying slightly out the money calls on the day, 0 DTE calls. The price goes up, market makers have to hedge, they bring the delta back into zero, they buy the underlying, and so much there is less about the fundamentals. You just need that positive catalyst, and then you get all these passive flows and these hedging flows, and people are trying to understand why it's the extent of the move, and that's exactly what happened. So, if the options market can kick, we've got options expiry on Friday, we've got about 3.1, trillion dollars of options notional expiring. This could kick, and people are trying to understand it's all about earnings, but it's not necessarily about earnings. The earnings have given life to these flows that take place, and that's why things could be exacerbated on that. Let's go to the Australian 200, because this is the ASX 200 in our market. I brought this up because, one, it's testing the 200-day moving average, and of course we know nothing good happens below the 200-day moving average. We're sitting right on it. We're just below that now, but I think that was taken just before Nvidia's earnings, so that might give a a bit of love to this market, but it's down 7 days in a row. And you know, when I'm screening, you know, the various global indices, there isn't a market. Maybe the FTSE as well. You know, that's been down pretty hard. Both value markets as opposed to growth markets, and that you see in other markets like the Hang Seng Nikkei and other bits and pieces. But yeah, technically this looks awful. So I think I'm selling rallies in this. Yeah, sentiment is pretty hurt. You know, tech has been down 21% since the recent high. It's the banks that you want to look at. CBA has been trading so poorly since its trading update, Q3 trading update. You know, and that's a big issue. You know, when do the value guys come in? Well, the valuation, if it matters, haven't been a problem for a long time. Has been a problem for a long time, but it's been driven mostly by passive flows. I like selling rallies in this. It looks horrible. It's down 7% in the drawdown. You know, I think we'll possibly get down to about 10%, and I think people then start nibbling away.
All right. Well, you know, nothing good happens below the 200 DMA, and nothing good happens after 2 a.m., kids. So just remember that. All right. All right. So my next setup is the US dollar Japanese yen. Last week we were talking about the breakout or the stall at the triangle. Well, it obviously broke out. This is a 4-hour chart. I've just condensed it, and we are into what I would call a resistance zone. This is the 88% and 78% confluence. Now, 78% of the previous 2024 range, which is basically the top and bottom of this entire chart. And then we are at the 78% retracement, or excuse me, 88% retracement of the 2025 range. And that's in this resistance zone. Now, a lot of people are talking about intervention. I'm with Chris. I don't think intervention is really in the cards at this point in time. Are there going to be, there's probably different steps. And I know our colleagues, Michael Brown and Ryan Littlestone on the UK Trade-Off, Ryan, who's my colleague at Forex Analytics, he talked about the intervention, the steps that would have to be taken by the BOJ. We're not there yet. So I think the next level that we can see is getting close to 160. And at 160, it's obviously a big, round number. It's a big figure level, but it's also those highs from, early in 2025. It's also the 88% retracement of this entire chart. That comes closer to 159 to 160. And I think those are the levels that, if you're going to talk intervention, I think those are the levels that we need to be more aware of.
Do you think, obviously the weaker it gets, it brings in a higher chance that we get the Bank of Japan hiking rates in the December meeting? I think, does the imported inflation that's happening there, and we've got national CPI coming out this week in Japan, and that's going to be slightly higher. So is it less about the intervention risk, which of course everyone's talking about, and more, does a 25 basis point hike become more of a probability given the weakening in the yen, and that becomes more of a dollar positive, a yen positive?
That's a great question, Chris, and I believe that to be the case, because the BOJ is really smart as far as they know what the reaction is going to be. They know where the yen should be and what the reaction would be on any type of action. So for them to utilize this yen weakness to their advantage to hike rates when they really need to normalize, why wouldn't they? And I do think that's actually a really great point that you bring up.
Cheers, Bob. Let's go to play of the day. Right, I'm going to go for the NASDAQ 100. I'm going to get my pantalons out and I'm going to go hard. But I'm not going to go that hard, actually. I'm going to wait for the market to go harder. And what I mean by that is that we've just seen that green candle. Obviously, that's in response to Nvidia's numbers. We're seeing buying in across the semi space, Broadcom, advanced micro devices, which I think actually have been top of mind recently for investors if they wanted to sort of play the buy the dip in the AI scene. They've gone into those two spaces. But the Mac Daddy within the scene, the highest weight on the market is looking good. Does it kick? Now, I'm not going to be buying them. I haven't bought the NASDAQ now, but I'm waiting for the market to break through that, the blue line there, just 24,900. And what I'm trying to do there is catch a break and hope that it continues to kick. Hope being the operative word. I mean, obviously, we don't know. It might fail and cut the profits, cut the market really quickly if it does, cut the loss really quickly. But is this the stage for something a bit more? I don't know, but I want to be involved if it does and then build the position. So if this does set up a rally back into the NASDAQ, after a time where sentiment has been pretty weak. I'm looking to buy strength and hope that it continues. The market continues to kick. A body in motion stays in motion, says a great man called Newton once upon a time.
Awesome, Chris. I love it. All right. So my play of the day is something that I feel a little kind of crazy doing right now. I'm actually short Canadian yen. We're at channel resistance. We're at a 618 retracement, and we are, if you look left, and that's what most traders have a difficult time doing. They have a hard time going and looking left. If you look left and go all the way back to July, end of July 2024, you'll notice a spike high that's over that black little arrow right there. That's recent highs. And so for me as a trader, I like like a revert to the mean, revision to the mean type of trade. And Chris, you were talking about the BOJ hiking rates. Well, if they could do that like in the next 24 hours, I'd be super happy. But I do believe that the dollar CAD is at some pretty good resistance. I'm more of a Canadian at this point in time. I'm more of a Canadian bear. I think the dollar Canadian's going back to 141, 143. So I think it's going to be going higher. I think that's going to weigh on the Canadian dollar, and hopefully the US dollar, Japanese yen struggles as sentiment is too extreme up at these levels. So I'm fading it. I've got a really tight risk on this, but it's at channel resistance, and I think it's at a lot of resistance just looking left.
Question for you.
Yeah.
What, of all the markets, asset classes, everything, what is the most mean reverting of all markets?
God, that's a good question. Of all markets?
Yeah.
I would say
FX. The big ones, the ones we look at.
I'm an FX person. I believe, the one thing I love about trading FX, Chris, is you don't have currencies. I mean, you don't have currencies go to zero, and rates. You could look at the euro today, and you could look at it like a year from now, and it's probably within the same general range, which gives us great opportunities when things get a little bit stretched in one direction or another. So my answer to you would be FX.
Yeah.
In general.
Well, FX is great because I mean the thing is with equities is they're made to, the system's made to go up. You've got central banks that support on dips and change policy. You've got Trump. You've got long only funds who buy pullbacks. All that sort of stuff. The system's made to go up. FX is up there. It's, for me, it's volatility. It's the VIX. That is the most mean. People just sell volatility on any spikes, and it just comes down every spike. Okay, so the VIX is the most mean reverting, and that's why you get the positive carry when you're short. But FX is definitely there because you're just playing one against another. You don't have a system that's necessarily designed just to go up and support it. Yeah. So I think you're right, but the VIX and volatility is for me the most mean reverting. But it's a great question, Chris, and I think it's definitely worth noting. But that's why you guys should wade into the FX waters with Chris and I sometime. Yeah, get your don't worry, the water's warm.
Trade
the mean reversion. That's a great strategy in FX markets. It works a lot. Anyway, Blake, thank you for your time and efforts and your insights, and everyone home, thank you for staying around. Smash the like button, subscribe to the channel, tell your friends and family, especially as we go into Christmas period. There's no better gift for the family there, and we'll see you back next week for more of the trade-off.